capital structure does not affect the value of the firm. There is a relationship among a capital structure, cost of capital, and the value of the firm. The use of debt does not change the risk perception of investors. According to this approach, the capital structure decision is relevant to the valuation of the firm. Hello everybody, I'm your Divya ma'am, Assistant Professor from Department of Commerce and Management, lecturing Vidhyaashram First Grade College, MYSURU, the Temple of Excellence. It's a warm welcome to you all for the session 10 on your Unit 1, Capital Structure Theories. In your first unit itself, they have given the topics, the two major topics for you all, that is the cost of capital and the WACC calculation, and they have also given the capital structure theories. So that has to be studied. So in your unit 1 only, the second topic that we are discussing in today's class is capital structure theories. Moving forward, the agenda for today's discussion, capital structure theories, will discuss what are the different capital structure theories, what is relevance approach, what is irrelevance approach, and what are the views that has been given by the various scientists, and what are the theories that they have propounded, and we'll be discussing about net income approach and the problems on net income approach. For everything, there's a format and the formulas that you people have to learn. Please learn the format and the problems carefully. Moving forward, capital structure theory. So let us understand the concept of capital structure theory first. What is capital? Capital is nothing but the investment. What is the structure? Structure is nothing but the combination of different source of finance that is used in order to raise the public fund. In order to raise the fund, we'll form a structure. What composition or what part of equity has to be taken, or the preference shares has to be taken, or debentures, or whatever the retained earnings, the long-term sources, the long-term decision with respect to the investment and the capital is called as capital structure. And they have given certain theories based on the experience, based on the live examples from the companies. They have given the theories. So let us understand. Capital structure theory is a major part of firm financial decision. So as a financial manager, it's a major part, major financial decision that they have to consider before forming a structure. Structure means making a combination of sources so that the value of the firm increases, at the same time the overall cost decreases. What is the main objective? To increase the value of the firm and to decrease the overall cost of capital, to decrease the cost. So which source is used? If debt is used or the equity is used, which combination is used, the optimum benefit the organization takes so that the value of the firm increases, at the same time the cost should decrease. So with this objective, capital structure is formulated, will be developed. So it is important to understand what is capital structure is all about. So it is a major financial decision which affects the value of the firm. It leads to the change in the earnings before interest and tax and market value of share. So value of firm means what? Market value of, in your particular market, what is the value of your firm? What is the earnings that you are doing before paying anything, that is interest and tax. Next, there is a relationship among a capital structure, cost of capital, and the value of the firm. So capital structure theories explains the relationship between the value of the firm. It explains the relationship between the cost of capital and the different capital structure. Though the aim of effective capital structure is to maximize the value of the firm and to reduce the cost of capital. So as I have mentioned y'all, the main objective, the main aim of a capital structure is to make the value of the firm, to maximize the value of the firm, and to reduce the cost of capital. Next, there are two major theories planning the relationship, which explains the relationship about capital structure, cost of capital and the value of the firm. So what are those theories? One is relevance theory, the other is irrelevance theory. Relevance theory and irrelevance theory. Relevance theory states or suggests that capital structure affect the value of the firm. So the combination of source of finance, the long-term source of finance we use in our a capital to raise the capital, that will affect the value of the firm. One theory says, and that is called as relevant theory or relevance theory. Under that, net income approach and traditional approach we have. Next we have is irrelevance theory. So under that, it says capital structure does not affect the value of the firm. So that we have is net operating income approach and MM approach. So these are the four important theories. So net income approach will be asked for 10 marks. So all these two combination of theories will be asked for 10 marks as a theory and also the practical problems to be solved. So now let us understand what is net income approach, what is net operating income approach, what is traditional theory, what is MM hypothesis in detail. Moving forward, net income approach. Net income approach was suggested by whom? It was suggested by David Durand. According to this approach, the capital structure decision is relevant to the valuation of the firm. The capital structure decision, what they make, will affect the value of the firm. So as I have said, all the theories are based on certain assumptions. So this theory, NI approach, which was suggested by David Durand, is also based on certain assumptions. In other words, a change in the capital structure leads to the correspondence change in the overall cost of capital. See, if the capital structure, if debt is used, the value of firm will decline. What is this? This is a value of, this is what the debt capital, usage of debt capital, equity capital will reduce the overall cost of capital. So this is the theory. This has a relevance towards the change in the capital structure. That is what this theory is suggesting. So change in the overall cost of capital will lead to the correspondence change in the capital structure is changed. Obviously, the overall cost of capital also changed. So there is a relevance that is there that we have to notice. So next we have is, according to this approach, use of more debt finance to reduce the overall cost of capital and increase the value of the firm. To increase the value of the firm, use of debt capital, the overall value increases with the decline in overall cost of capital. So what this theory, according to this theory, what it suggests, what it says, use of more and more debt finance will reduce the overall cost of capital. Using more and more debt finance, it will reduce the overall cost of capital, and it also increases the value of the firm. So this is what this suggests. So this is for 10 marks. This theory will be asked for 10 marks. So with a diagrammatic representation, you all have to present it. So in short, to explain in brief, net income approach. So net income approach was suggested by David Durand. So according to this approach, use of debt capital will affect the value of the firm. So use of more debt capital into the capital structure, it will increase the value of the firm by declining the overall cost of capital. And it also says, when there is a change in the capital structure, there is also correspondence change in the valuation of firm and the overall cost of capital. So this is what the NI approach says. Moving forward, so as I have suggested, as I have told you all, so net income approach is based on certain assumptions. Tax, there is no tax rate. The cost of debt is less than cost of equity. It's an assumption, but this is not applicable in today's generation. So there is no place where there is no tax rates. Everywhere, for everything, you have to pay the tax. And the use of debt does not change the risk perception of investors. So based on these three assumptions, we have net income approach. So net income approach, few of the abbreviations you all have to understand. Total market of equity, symbolically represented as E. This is total market value of debt. This is total market value of firm, which is symbolically represented as V. Interest, net operating profit or EBIT. So this is dividend, this is expected dividend, and this is the current market price of the share. Next, expected market price of share for 1 year, cost of debt, cost of equity, and overall cost of capital. So in your formula, you can understand. See, this is the formula. To make you all understand in a better way, I have made a format and then I have given you all, so particulars amount, format to find out the value of firm. To find out the value of firm, to find out the equity, to find out the overall capitalization rate, that is overall cost of capital. So to find out this is a format. Net operating income or EBIT, less interest, you get EBIT, earnings before interest and tax. If you divide it, you get equity capitalization rate. Then with that, if you divide it, you'll get your EBIT, that is earnings before tax. And if you divide with equity capitalization rate, you'll get your market value of firm. With that, if you add the market value of debt, you'll get your total value of firm. So overall capitalization rate. So this only they'll ask you to calculate in your NI approach to know overall capitalization rate, that is K subscript with O. So overall capitalization rate is equal to EBIT divided by value into 100. So my dear students, in your question EBIT will be given, but value of firm will not be given. In order to find out the value of the firm, we need to follow this format as I have put you all on the screen. So into 100, if we do it, we'll get the overall capitalization rate. Next, this is verification formula. So overall capitalization rate is equal to cost of debt D divided by V, debt divided by V, plus cost of equity E divided by V. So this is the verification formula. Next, moving forward, we'll take up the problem. Problem number 1. Let's understand the questions carefully. A company expects to earn net operating income, EBIT, earnings before interest and taxes given. How many lakhs? 3,60,000. Then what is given? It has been rupees 12 lakh, 10% debenture. So debt is given. How many rupees is the debt, the value they have given? 12 lakh is the debt value given. 10% is the interest rate. 12 lakh into 10%, that is your interest. Equity capitalization rate is given 12%. If you convert into decimal, it will be 0.12. And also calculate the overall cost of capital using NI approach. So in NI approach, they'll ask you to calculate the overall cost of capital. So what is the format? Particulars and amount. So under this, what is the, according to our format, what is the first thing? EBIT, earnings before interest and tax, 3,60,000 as they have given in the question. Next is less interest. Interest is always calculated on what? On debenture. So let's use the calculator and check out. So 12 lakh into 10%, it is 1,20,000. So 3,60,000 minus 1,20,000, it is 2,40,000. What is this 2,40,000? Earnings before tax. Earnings before tax is 2,40,000. So if you divide this with the equity capitalization rate given in the question, What is the equity capitalization rate given? 12 divided by 100, it is 0.12. So 2,40,000 divided by 0.12, it is 20 lakh. So what is this 20 lakh? Market value of equity. That is market value of equity. With this, if we add the market value of debt, what is this market value of debt? I am writing everything in a symbolically. I am writing everything symbolically. So kindly you have to write in a statement. So if you add the debt, that is 12 lakh. So 20 lakh plus 12 lakh, it will be 32 lakhs. So what is this 32 lakhs? Market value of firm. Market value of firm. So now what is the formula? Overall capitalization rate is EBIT divided by value of firm, market value of firm into 100. So what is EBIT given in the question? 3,60,000 divided by what is the market value of firm? What is the market value of firm? We have calculated 32 lakhs into 100. If we calculate, what will be the answer? It is 11.25%. So this is how we calculate the problem based on NI approach by calculating overall capitalization rate, that is K subscript with E. Moving forward, let's discuss problem number 2 for more clarity on NI approach. So what is given in the question? Equity share capital, that is cost of equity, is 10% and 6% debenture, that is debt of 5 lakh. So 5 lakh into 6% will be the interest rate. Find out the value of the firm and the overall cost of capital. And they've also asked if the firm has issued 6% debenture of rupees 7 lakh instead of 5 lakh, what would be the position of the firm and the cost of equity. So two calculation has to be done here, since there is a changes in the debt capital. Interest also changes and the debt also changes. So next, according to the format, particulars, amount for case 1 and for case 2. Situation 1 and situation 2. Okay, what is the format? Earnings before interest and tax or net operating income. What is that given in the question? 2 lakh and 2 lakh. Next, deduct interest. So for the first case, what is the interest rate? 6% on 5 lakh. So 5 lakh into 6%, it is 30,000. 2 lakh minus 30,000, it is 1,70,000. Next, for the case B, here they have changed the amount of debt. So percentage remains the same. So 7 lakh into 6%, it is 42,000. 2 lakh minus 42,000, it is 1,58,000. 1,58,000. Next, what is the format? What we get after deducting the interest? Earnings before tax. Next, we have to divide this with equity capitalization rate. What is equity capitalization rate given in the question? 10%. So 10 divided by 100, 0.1. If you divide 1,70,000 divided by 0.1, it is 17 lakh. Next, 1,58,000 divided by 0.1, it is 15,80,000. It is 15,80,000. Next, what is the calculation? What we have found now? It is nothing but market value of equity. With this, we have to add what? Market value of debenture. or debt. What is the debenture given in the question? For this, for the case 1 it is 5 lakh and for the case 2 it is 7 lakh. Now let's calculate. 17 lakh add debenture, that is 5 lakh, 22 lakhs. Next, 15 lakh 80,000 plus 7 lakh, it is 22 lakh 80,000. What is this? 22 lakh 80,000, it is market value of firm. So this we'll substitute into the formula. What is the formula for the case 1 and for the case 2? What is the formula? EBIT divided by market value of firm into 100. So what is EBIT? 2 lakh is the EBIT divided by value of firm is how much? 22 lakhs into 100. Similarly, we have to do it for the case B, that is your second case wherein debt has been increased to 7 lakh. So what will be the EBIT? EBIT is 2 lakh again and the value of firm we have got is 22 lakh 80,000. Two lakh divided by 22 lakh into 100, it is how much? It is 9.9%. Again, next if we do it for the case B, that is 2 lakh divided by 22 lakh 80,000 into 100, it is 8.77%. So this is how we need to calculate the NI approach using the overall cost of capital formula with the format I have given, wherein you all have to calculate the value of the firm. So that's it, my dear students. Hope the session was very interesting and fruitful. Smile is the biggest jewel you can wear, people. Keep smiling. Thank you.